Question 1. An insured's health policy includes a provision that states if the insured is injured and becomes totally disabled, the insurer will waive premiums for the duration of the disability. This is an example of which policy provision? A. Entire contract clause. B. Reinstatement provision. C. Waiver of premium provision. D. Time limit on certain defenses. Answer: C. Waiver of premium provision. The waiver of premium provision is a common rider or provision in health insurance policies, especially disability income, that exempts the insured from paying premiums while they are totally disabled. This ensures that the policy remains in force and benefits are paid, even when the insured's income is interrupted due to their disability. For example, if someone becomes permanently disabled and cannot work, this provision means they won't have to worry about paying premiums to keep their crucial health or disability coverage. Remember, this provision helps protect your coverage when you need it most. Question 2. All of the following are characteristics of a health maintenance organization, HMO, except A. Emphasis on preventive care. B. Subscribers pay a fixed periodic fee. C. Access to specialists typically requires a referral from a primary care physician, PCP. D. Members can seek care from any provider and still receive full coverage. Answer: D. Members can seek care from any provider and still receive full coverage. Health maintenance organizations, HMOs, are known for their managed care approach, which typically limits coverage to providers within the HMO's network. While HMOs emphasize preventive care, require a fixed periodic fee from subscribers, and often necessitate referrals from a primary care physician to see specialists, they do not offer full coverage for care received from out-of-network providers. This contrasts with other plans like PPOs that offer more flexibility but often at a higher cost for out-of-network services. Always remember that HMOs prioritize coordinated care within their specific network. Question 3. What is the main purpose of the Affordable Care Act, ACA? A. To restrict health insurance coverage to employer-sponsored plans only. B. To expand access to affordable health insurance and protect consumers from abusive practices. C. To eliminate all private health insurance plans in favor of a single-payer system. D. To primarily provide health insurance to individuals over age 65. Answer: B. To expand access to affordable health insurance and protect consumers from abusive practices. The Affordable Care Act, ACA, also known as Obamacare, was enacted to significantly broaden health insurance coverage and establish regulations protecting consumers. Key provisions included mandating coverage, creating health insurance marketplaces, expanding Medicaid, and prohibiting insurers from denying coverage due to pre-existing conditions. For instance, before ACA, someone with a chronic illness might have been denied coverage, but now insurers cannot do that. Understanding the ACA's consumer protections is crucial as it shapes much of the modern health insurance landscape. Question 4. The grace period for a health insurance policy is typically how long for a weekly premium payment mode? A. 7 days. B. 10 days. C. 20 days. D. 31 days. Answer: A. 7 days. The grace period is the length of time after a premium payment is due during which the policy remains in force, even if the premium hasn't been paid. For policies with weekly premium payments, the standard grace period is 7 days. If an insured misses a weekly premium payment, they have 1 week to pay it before the policy lapses. The specific length of the grace period depends on the premium payment mode. Weekly premiums get 7 days, monthly get 10 days, and all other modes, like quarterly or annual, get 31 days. This provision ensures policyholders have a short window to correct a missed payment without immediately losing coverage. Question 5. Which of the following statements about group health insurance is generally true? A. Group plans typically require individual medical underwriting for each member. B. Group plans are usually more expensive than individual plans for comparable coverage. C. Group plans often offer broader coverage and lower premiums due to risk pooling. D. Group plans are only available to employees of large corporations. Answer: C. Group plans often offer broader coverage and lower premiums due to risk pooling. Group health insurance policies benefit from risk pooling, meaning a larger and more diverse group of individuals share the risk, which often leads to lower average premiums and more comprehensive coverage compared to individual plans. Unlike individual plans, group plans typically do not require individual medical underwriting, making them accessible even to those with pre-existing conditions. For example, a small business offering health insurance to its employees can get better rates and benefits than if each employee purchased an individual policy. Group insurance is a popular choice for employers precisely because it offers these advantages. Question 6. A policy owner cancels their health insurance policy shortly after purchasing it. The insurer must refund any unearned premiums within how many days of the cancellation, according to the free look provision, in many states? A. 10 days. B. 20 days. C. 30 days. D. 45 days. Answer: A. 10 days. The free look provision allows a policy owner to review a new health insurance policy for a specified period after delivery, typically 10 days, though it can be longer for certain policies like Medicare supplements, which often have 30 days. If the policy owner decides not to keep the policy during this free look period, they can return it for a full refund of any premiums paid. This provision gives consumers a no-risk way to examine their new coverage. Always encourage clients to use their free look period to ensure the policy meets their needs before committing. Question 7. An insured has a health insurance policy with a $1,000 deductible and an 80/20 coinsurance clause. If the insured incurs $6,000 in covered medical expenses, what is the insured's total out-of-pocket cost, assuming no stop-loss limit has been met? A. $1,000. B. $1,200. C. $2,000. D. $3,000. Answer: C. $2,000. To calculate the insured's out-of-pocket cost, first subtract the deductible from the total expenses. $6,000 to $1,000 equals $5,000. This $5,000 is the amount subject to coinsurance. With an 80/20 coinsurance, the insurer pays 80% and the insured pays 20% of this remaining amount. So, the insured's coinsurance share is 20% of $5,000, which is $1,000. The total out-of-pocket cost for the insured is the deductible plus their coinsurance share, $1,000, deductible, plus $1,000, coinsurance, equals $2,000. Understanding how deductibles and coinsurance work together is key to explaining policy costs to clients. Question 8. Which type of renewability provision offers the greatest degree of protection for the insured? A. Optionally renewable. B. Conditionally renewable. C. Guaranteed renewable. D. Non-cancellable. Answer: D. Non-cancellable. A non-cancellable renewability provision offers the strongest protection because the insurer cannot cancel the policy, nor can they increase the premiums, as long as the insured pays the premiums on time. This provides peace of mind that coverage will remain in force at the original rate, regardless of the insured's health status or age. In contrast, guaranteed renewable policies allow the insurer to increase premiums for classes of insureds, and optionally/conditionally renewable policies provide less certainty. Non-cancellable coverage is highly desirable because it locks in both renewability and premium rates. Question 9. The provision that states an insured's misstatements on an accident and health application cannot be used to void the policy after a certain period, usually 2 or 3 years, is known as the A. Grace period. B. Legal actions clause. C. Reinstatement provision. D. Time limit on certain defenses. Answer: D. Time limit on certain defenses. The time limit on certain defenses provision prevents an insurer from voiding a health policy based on misstatements made by the insured in the application after a specified period, typically 2 or 3 years, unless the misstatement was fraudulent. This clause protects the insured by limiting the time frame during which an insurer can challenge the validity of the policy due to inaccuracies on the application. For instance, if an applicant unintentionally forgets to mention a minor past health issue, this provision ensures their policy won't be cancelled years later for that oversight. Remember, this clause provides a time limit for the insurer to discover and act on non-fraudulent misrepresentations. Question 10. All of the following are typically covered under a comprehensive major medical policy except A. Hospital room and board. B. Surgeon's fees. C. Routine dental care. D. Prescription drugs. Answer: C. Routine dental care. Comprehensive major medical policies are designed to cover a broad range of medical expenses, including hospital stays, surgical procedures, and prescription medications, after deductibles and coinsurance are met. However, routine dental care, vision care, and hearing aids are typically excluded from standard major medical policies and require separate, specialized plans. For example, getting a cavity filled or a routine teeth cleaning would not be covered by a standard major medical policy. Always confirm specific exclusions when reviewing a major medical policy to manage client expectations. Question 11. Which federal law allows employees to continue their group health coverage for a limited time after a qualifying event, such as job loss or reduction in hours? A. HIPAA. B. ACA. C. COBRA. D. Medicare. Answer: C. COBRA. The Consolidated Omnibus Budget Reconciliation Act, COBRA, is a federal law that gives workers and their families who lose their health benefits the right to choose to continue group health benefits provided by their group health plan for limited periods under certain circumstances. These qualifying events include voluntary or involuntary job loss, reduction in the hours worked, transition between jobs, death, divorce, and other life events. For instance, if someone is laid off, COBRA allows them to keep their employer-sponsored health coverage for up to 18 months, though they usually pay the full premium plus an administrative fee. COBRA is a critical safety net for temporary gaps in employment. Question 12. Which of the following is typically not considered a gatekeeper in an HMO plan? A. Primary care physician, PCP. B. Specialist. C. Family doctor. D. General practitioner. Answer: B. Specialist. In a health maintenance organization, HMO, plan, the gatekeeper is typically the primary care physician, PCP, who is responsible for managing and coordinating the insured's overall healthcare. This includes providing routine care and referrals to specialists when necessary. Specialists, such as cardiologists or dermatologists, are generally seen only after a referral from the PCP. The gatekeeper system is a core feature of HMOs designed to control costs and ensure appropriate utilization of medical services. Understanding the PCP's role as a gatekeeper is fundamental to explaining how HMOs function. Question 13. Which part of Medicare covers inpatient hospital care, skilled nursing facility care, hospice care, and some home health care? A. Medicare Part A. B. Medicare Part B. C. Medicare Part C. D. Medicare Part D. Answer: A. Medicare Part A. Medicare Part A, often called hospital insurance, primarily covers inpatient care in hospitals, including semi-private rooms, meals, and necessary medical services. It also covers skilled nursing facility care after a qualifying hospital stay, hospice care for terminally ill patients, and some home health services. Most eligible individuals do not pay a premium for Part A if they or their spouse paid Medicare taxes through employment for a sufficient period. Remember, A stands for hospital, making it easy to associate Part A with inpatient services. Question 14. An insured needs nursing home care due to a chronic illness that limits their ability to perform activities of daily living, ADLs. What type of insurance would typically cover this expense? A. Major medical insurance. B. Disability income insurance. C. Accidental death and dismemberment, AD&D, insurance. D. Long-term care, LTC, insurance. Answer: D. Long-term care, LTC, insurance. Long-term care, LTC, insurance is specifically designed to cover the costs associated with long-term care services, such as nursing home care, assisted living facilities, and home health care, when an individual can no longer perform a certain number of activities of daily living, ADLs, or has a severe cognitive impairment. Major medical policies do not cover extended custodial care, and disability income replaces lost wages, not care costs. For instance, if an individual develops Alzheimer's disease and requires assistance with bathing and eating, an LTC policy would provide financial support for their care needs. LTC insurance helps protect assets from the potentially devastating costs of extended care. Question 15. The coordination of benefits, COB, provision in group health insurance is designed to A. Coordinate benefits between a primary and secondary health insurance plan to prevent overpayment. B. Allow an insured to choose any doctor they want without penalty. C. Determine the amount of the deductible the insured must pay. D. Ensure that all group members have the same coverage regardless of their needs. Answer: A. Coordinate benefits between a primary and secondary health insurance plan to prevent overpayment. The coordination of benefits, COB, provision is a common clause in group health insurance policies that prevents an insured from receiving more than 100% of the actual medical expenses when covered by two or more group plans. It establishes which plan is primary and which is secondary, ensuring that the primary plan pays its benefits first, and then the secondary plan pays any remaining eligible expenses, up to its limits. For example, if both spouses have group health coverage, COB rules dictate which plan pays first for a child's medical bills. This provision prevents individuals from profiting from their medical expenses by receiving duplicate payments. Question 16. What is the primary purpose of the incontestability clause in a health insurance policy? A. To allow the insurer to contest claims at any time if fraud is suspected. B. To prevent the insurer from denying a claim based on misstatements in the application after a specified period. C. To guarantee that the policy cannot be cancelled by the insurer under any circumstances. D. To allow the insured to contest the terms of the policy at any time. Answer: B. To prevent the insurer from denying a claim based on misstatements in the application after a specified period. The incontestability clause, often closely related to the time limit on certain defenses, typically states that after a policy has been in force for a certain period, usually 2 or 3 years, the insurer cannot deny a claim or void the policy based on any misstatements made by the insured in the application, unless those misstatements were fraudulent. This clause protects the insured by providing assurance that their coverage cannot be challenged indefinitely due to honest errors on the application. For instance, if an insured accidentally marked "no" to a question about a past minor health issue, this clause prevents the insurer from denying a claim years later based on that oversight. It ensures stability and predictability for the policyholder. Question 17. Which of the following best describes the elimination period in a disability income policy? A. The period during which the insured is considered totally disabled. B. The maximum length of time that benefits will be paid. C. The time period between when a disability occurs and when benefit payments begin. D. The period before pre-existing conditions are covered. Answer: C. The time period between when a disability occurs and when benefit payments begin. The elimination period, also known as the waiting period, in a disability income policy is the specified length of time, starting from the onset of a disability, during which the insured must be continuously disabled before benefits become payable. It functions similarly to a deductible, in that the insured must pay for this initial period out of their own pocket, typically in terms of lost income. For example, if a policy has a 90-day elimination period, the insured would have to wait 3 months from the start of their disability before receiving their first benefit payment. A longer elimination period usually results in a lower premium. Question 18. Under HIPAA, what is the maximum number of days an insurer has to notify an applicant if the applicant's medical information is going to be shared with third parties? A. 10 days. B. 20 days. C. 30 days. D. 60 days. Answer: C. 30 days. Under the Health Insurance Portability and Accountability Act, HIPAA, an insurer must provide a written notice to an applicant within 30 days if their medical information is to be shared with any third party, such as for underwriting or claims processing. This privacy rule is a cornerstone of HIPAA, ensuring that individuals are informed about how their protected health information, PHI, is used and disclosed. This notification ensures transparency and allows individuals to understand and potentially control the dissemination of their sensitive health data. It's crucial for protecting patient privacy. Question 19. A type of health insurance policy that pays a lump sum benefit directly to the insured upon the diagnosis of a specific life-threatening illness, such as cancer or a heart attack, is known as A. Major medical insurance. B. Disability income insurance. C. Critical illness insurance. D. Long-term care insurance. Answer: C. Critical illness insurance. Critical illness insurance pays a lump sum benefit directly to the insured upon the diagnosis of a predefined serious illness, like cancer, heart attack, stroke, or kidney failure. Unlike major medical insurance, which pays providers for services, or disability income, which replaces lost wages, critical illness policies provide cash that can be used for any purpose, such as medical deductibles, travel for treatment, or even living expenses. For example, if someone is diagnosed with cancer, this policy would pay a specified amount directly to them to help alleviate financial burdens. This type of policy offers financial flexibility during challenging health crises. Question 20. Which entity within a PPO, preferred provider organization, typically manages the network of healthcare providers? A. The insured individual directly. B. A designated primary care physician. C. The PPO itself, usually an insurance company or third-party administrator. D. The state's Department of Insurance. Answer: C. The PPO itself, usually an insurance company or third-party administrator. In a preferred provider organization, PPO, the network of healthcare providers is managed by the PPO organization, which is typically an insurance company or a third-party administrator, TPA. This organization contracts with a network of doctors, hospitals, and other healthcare providers to offer services at discounted rates to its members. Members can choose to see in-network providers for lower costs or out-of-network providers for higher costs. This contrasts with an HMO where a PCP often acts as a gatekeeper. Understanding that the PPO itself manages the network helps clarify its operational structure. Question 21. Under which type of health insurance coverage would an individual generally pay a small, fixed copayment at the time of service, with the insurer covering the majority of the remaining costs for in-network care? A. Indemnity plan. B. High deductible health plan, HDHP. C. Point of service, POS, plan. D. Health maintenance organization, HMO. Answer: D. Health maintenance organization, HMO. In a health maintenance organization, HMO, members typically pay a fixed periodic fee, premium, and then small, fixed copayments at the time they receive services, such as a doctor's visit or prescription. The HMO then covers the majority of the remaining costs, provided the care is received within its network and often with a referral from a primary care physician. This structure emphasizes predictable out-of-pocket costs at the point of service. Remember, predictable copayments are a hallmark of HMOs, making budgeting for routine care easier. Question 22. All of the following are generally tax-deductible health expenses for individuals, assuming certain IRS criteria are met, except A. Premiums paid for individually owned disability income insurance. B. Premiums paid for long-term care, LTC, insurance, subject to age-based limits. C. Medical expenses exceeding a certain percentage of adjusted gross income. D. Premiums paid for individual health insurance policies, e.g., ACA marketplace plans. Answer: A. Premiums paid for individually owned disability income insurance. While many health-related expenses and premiums can be tax-deductible under certain conditions, premiums paid for individually owned disability income insurance are generally not tax-deductible. The reason is that if the premiums were deductible, the benefits received from such a policy would then be taxable. Conversely, because the premiums are not deductible, the disability income benefits received are typically tax-free. This is an important distinction to remember for tax planning. Question 23. An insured's health policy specifies that the policy will pay benefits for a specific number of years or up to a specific dollar amount for long-term care services. This describes the policies. A. Elimination period. B. Coinsurance provision. C. Benefit period. D. Daily benefit amount. Answer: C. Benefit period. In a long-term care, LTC, insurance policy, the benefit period refers to the maximum length of time, e.g., 2 years, 3 years, 5 years, or lifetime, or the maximum dollar amount, e.g., $150,000, $300,000, that the policy will pay benefits. This is different from the elimination period, which is the waiting time before benefits begin. For example, a policy might have a 3-year benefit period, meaning it will pay for covered services for up to 3 years once benefits start. Understanding the benefit period is crucial for knowing the total potential payout from an LTC policy. Question 24. Which of the following is typically a characteristic of a self-funded health insurance plan? A. The employer assumes the financial risk for providing healthcare benefits to its employees. B. The employer pays a fixed premium to an insurance company, which assumes the risk. C. Employees are restricted to a very limited network of providers. D. It is primarily regulated by state insurance departments. Answer: A. The employer assumes the financial risk for providing healthcare benefits to its employees. In a self-funded health insurance plan, the employer directly assumes the financial risk for paying their employees' healthcare claims, rather than paying fixed premiums to an insurance company that then bears the risk. While the employer might contract with a third-party administrator, TPA, for administrative services like claims processing, the ultimate financial responsibility lies with the employer. This contrasts with fully insured plans where an insurance company takes on the risk. Self-funded plans are often regulated by federal law, ERISA, rather than state law. Question 25. An insured has a health insurance policy that states, benefits will be paid for a maximum of 26 weeks for any one disability. This is an example of what kind of provision? A. Recurrent disability clause. B. Benefit period. C. Elimination period. D. Non-disabling injury provision. Answer: B. Benefit period. The statement, benefits will be paid for a maximum of 26 weeks for any one disability, defines the benefit period of the policy. The benefit period is the maximum duration for which benefits will be paid for a covered disability or illness. It specifies how long the policy will provide financial support, in this case, up to 26 weeks. For instance, if someone is disabled for 30 weeks, the policy would only pay for the first 26 weeks. Understanding the benefit period is essential for an insured to know the limits of their coverage.